So the Fed is really struggling to battle inflation. So, they're really having to reduce their balance sheet, and they're giving signals that they're going to have to raise rates much faster than originally anticipated. Really not a surprise given the environment, but anyway, the market was in a bit of recovery mode and still is technically. The market's still very much kind of a touch and go right now. So we're going to explore that today. So stick with me. My name is Brian Cannon, and welcome to Markets in 5. All right, so let's dive into the market real quick. The S&P 500, of course, was in this downtrend that we had talked about. So lower highs, lower lows, kind of broke our support. Bounced around a little bit, came back through, broke through the resistance, and now it seems to be in a pattern of higher highs and higher lows. So even though we've had a drop from the peak a week or so ago, that's okay. It's still healthy. It doesn't feel good when you open your account and you see it down a little bit, but at the end of the day, the market doesn't head one direction, without some bumps in the road. So, as long as we hold these various levels of support here, we've got highlighted in the blue, then the upward trend is still in motion and still in play. So we've got to, hang through it and certainly make some tactical decisions along the way. But at the end of the day, as long as we're heading the right direction, it's fine. And so again, these are the levels we're watching. And in the end of the day, if they don't hold the levels, we make adjustments to protect. We take risk off the table. And so right now we're not to that point quite yet, but we are watching these levels. It did drop down, touched the 20-day moving average yesterday, and seems to be bouncing right around that 200-day moving average. So from a technical standpoint, the market doesn't look terrible at this point. So when we talk about, the market doesn't look terrible, we still always need to be looking for signs of weakness. And this is one sign that we're watching very closely. It's not a definitive signal yet, but it is certainly one that could manifest itself. And if it is, then it's something we need to pay attention to and quite frankly act on. So when we look at consumer staples relative to the S&P, consumer staples are your need to haves, right? Your toilet paper, your Band-Aids, things that irregardless of what's going on in the market, people have to purchase those things. And so when we look at consumer staples relative to the S&P 500, that's the relative performance line in the pink. And and behind that in the black is the S&P 500. So you can see when, relatively speaking, staples start to outperform the S&P 500, it's usually an inverse relationship. So when the relationship is heading up, the S&P is heading down, and quite frankly, when the relationship is heading down, the S&P is heading up. So it's an important inverse relationship we need to really watch for. So the consumer staples relative to the S&P 500 is in a downtrend, which is good. So that means the S&P is in a long-term uptrend. However, you are starting to see this relationship starting to build and grow. So there is a kind of a line in the sand, if you will. In other words, that red arrow right there, if this relationship starts to break out, then you can assume that the S&P is more than likely going to start heading down again. So even though we've had a breakout on the S&P 500, we just need to watch these levels. But if we start to see the consumer staples relative to S&P starting to break out, that's not a good sign. And we've got a rising RSI level here, and that's a little bit worrisome. And we've got a kind of a golden cross kind of breakout here in the MACD relationship. So again, it hasn't broken the trend to the upside quite yet, but it is something that we're watching very closely. So again, kind of a touch and go situation. Stay tuned. All right, so the final chart I just wanted to kind of touch on. Last week or 2 weeks ago in Markets at 5, we talked about the canary in the coal mine and the fact that the yield curve was heading toward an inversion relatively quickly. And we, in fact, did get that inversion. So even though it just barely touched it and seemed to pop back up, I would say with the Fed tightening and raising rates, we're more than likely that's not the end of the story as far as the yield curve inversion. I think it's going to continue to invert, and that usually is not a good sign for the market. So again, I think it takes anywhere from a year to a couple, maybe 2 or 3 years before you receive a recession. But I would say this is a telling sign that a recession is coming at some point. But again, you just can't put your head under the blanket and or go to cash and just sit there and wait, because inflation is going to eat up your returns. So you've got to play the market, but you just have to be more active and more agile and be able to take risk off when necessary, and put it on when market conditions are good. Otherwise, you're going to lock in a loss just simply by the fact that you're sitting in cash and inflation's running hot at 7 or 8%. You're locking in a 7 or 8% loss. So that's not a good answer either. So as I think you can tell from some of these charts, there's some positive things in the market and there's some negative things in the market. And really at this point, we're not quite sure which way the scale is going to tip. But that's just something that we're watching very closely, is all those various charts as well as many other indicators. But certainly if you have any questions, give me a shout, and I look forward to seeing you on the next Markets in 5.